Lesson Introduction. Fundamentals means understanding the actual business behind the stock. A stock chart shows us the price, but fundamentals help explain whether the company deserves that price. When we study fundamentals, we look at three main areas: business quality, is the company growing, is it making profit, does it have strong cash flow, financial risk, does the company have too much debt, is it using leverage safely, is the balance sheet strong or weak, valuation. Is the stock price cheap, fair, or expensive compared to the company's real value? This is important because a stock can look strong on a chart, but if the business is weak, the move may not last. Good fundamentals help investors understand the strength of the company before buying the stock. Lesson Explanation. The goal of this lesson is to help students understand how to study a company before buying its stock. Before buying any stock, we do not want to only look at the chart. We also want to understand the business behind the stock. In this lesson, students will learn how to look at important numbers like revenue, earnings, profit margins, debt, and cash flow. These numbers help us see if the company is growing, making money, and managing its finances properly. Students will also learn important ratios like PE, PEG, price to sales, and debt to equity. These ratios help us compare the stock price to the company's real value and financial strength. Another important part of fundamentals is earnings reports and guidance. Earnings reports tell us how the company performed, and guidance tells us what the company expects in the future. This is why stocks often move sharply after earnings. By the end of this lesson, students should be able to create a simple checklist before buying a stock. The main question we always want to ask is this stock backed by a strong business, or is it only moving because of hype? Fundamentals are the financial numbers and business details behind a stock. They help us understand if a company is actually strong, not just if the stock price is moving up. When studying fundamentals, we look at 5 key areas. Growth. Is the company increasing revenue and earnings over time? A strong company should be growing its sales and profits. Profitability. Is the company keeping enough profit after expenses? Margins and cash flow show whether the business is strong and efficient. Risk. Does the company have too much debt or leverage? High debt can put pressure on the company, especially when interest rates are high or business slows down. Valuation. Is the stock cheap, fair, or expensive compared to the company's earnings, sales, growth, and cash flow? Management. Who is running the company? We want to look at the CEO, company guidance, execution, and insider buying or selling. The big idea is this. A chart can tell us what traders are doing, but fundamentals tell us what kind of business we are actually buying. Revenue and earnings are 2 of the most important numbers in fundamentals. Revenue means total sales. This shows how much money the company brings in before paying expenses. If revenue is growing, it usually means customers are buying more products or services from the company. Earnings means profit. Earnings are what is left after the company pays costs, taxes, wages, interest, and other expenses. The simple formula is revenue, expenses equal sign earnings. A company can have strong revenue but still lose money if expenses are too high. That is why we do not only look at sales. We also want to know if the company can turn those sales into profit. The best companies often grow both revenue and earnings consistently over time. That tells us the business is not only selling more, but also becoming stronger and more profitable. Profit margin shows how much profit a company keeps from each dollar of sales. The formula is profit margin equals sign net income revenue x 100. For example, if a company has $100 in revenue and keeps $20 in profit, the profit margin is $20 $100 x 100 equals sign 20%. That means for every dollar the company makes in sales, it keeps 20 cents as profit. Improving margins can be a good sign. It may mean the company has strong pricing power, better cost control, or is becoming more efficient. Shrinking margins can be a warning sign. It may mean costs are rising, competition is hurting the business, or demand is slowing down. We should also compare profit margins with other companies in the same industry. A 20% margin may be strong in one industry but weak in another. The main idea is revenue shows how much money comes in. Profit margin shows how much the company actually keeps. Debt is money a company has borrowed and must pay back. Debt is not always bad. If a company uses debt wisely, it can help the business grow faster. But too much debt can become dangerous. When a company has high debt, it must make regular interest payments. If interest rates go up, that debt becomes more expensive. This can reduce profits and put pressure on the business. That is why we also look at cash. Cash helps a company operate, pay bills, invest in growth, and survive difficult markets. A company with low debt and strong cash is usually in a safer position. A company with high debt and weak cash can be more risky, especially during recessions or slowdowns. We should also compare debt levels with companies in the same sector. Some industries naturally use more debt than others. The main idea is debt can help a company grow, but too much debt can hurt profits and increase risk. The debt-to-equity ratio is one of the most important ratios for measuring how much leverage a company is using. The formula is debt-to-equity equal sign, total debt, shareholder equity. This ratio compares how much money the company borrowed versus how much value belongs to the shareholders. For example, a company has $100 million in debt and $200 million in shareholder equity. $100 million slash $200 million equal sign 0.50. That means the company has 50 cents of debt for every $1 of shareholder equity. A lower ratio usually means the company is more conservative with debt. A ratio around 1.0 means debt and equity are about equal. A ratio above 2.0 means the company is using more leverage, which can increase risk. But we should not judge the number by itself. Some industries like banks, utilities, and real estate normally carry more debt. That is why we always compare the ratio with companies in the same sector. The main idea is, debt to equity helps us see whether a company is using debt safely or taking on too much financial risk. Cash flow shows the real money moving through the business. A company may report profit on paper, but cash flow tells us whether real cash is coming in and staying in the company. One important formula is free cash flow equal sign operating cash flow. Capital expenditures. Operating cash flow is the cash generated from the company's normal business operations. Capital expenditures are major business spending, such as equipment, factories, technology, or property. After these costs, free cash flow shows how much cash is left over. Strong free cash flow is very important because a company can use it to pay down debt, pay dividends, buy back shares, invest in future growth, or protect itself during difficult markets. Negative cash flow can be a warning sign because the company may need to borrow money, raise financing, or issue more shares. The main idea is earnings show profit, but cash flow shows the real financial strength of the business. Valuation ratios help us understand whether a stock is cheap, fair, or expensive compared to the company's business numbers. A company can be excellent, but if the stock price is too high, it may still be a bad investment. That is why valuation matters. P/E ratio compares the stock price to the company's earnings. It helps us see how much investors are paying for each dollar of profit. Forward P/E compares the stock price to expected future earnings. This is useful because the market usually looks forward, not backward. PEG ratio compares the P/E ratio to the company's growth rate. This helps us see whether a high P/E is justified by strong growth. PS ratio compares the stock price to sales. This can be useful for companies that are growing fast but may not yet have strong profits. PFCF ratio compares the stock price to free cash flow. This helps us see how expensive the company is compared to the real cash it produces. The important lesson is, a great company can still be a bad investment if you pay too high a price. This slide explains the most common valuation ratios and what question each one answers. P/E ratio means price to earnings. The formula is stock price slash EPS. It tells us how much investors are paying for $1 of company earnings. A high P/E may mean investors expect strong growth, but it can also mean the stock is expensive. Forward P/E uses expected future earnings instead of past earnings. The formula is stock price expected EPS. This helps us understand how the market is valuing the company based on future expectations. PEG ratio compares valuation to growth. The formula is P/E earnings growth. This helps answer, is the P/E reasonable for how fast the company is growing? Price to sales compares the company's market value to revenue. The formula is market cap slash revenue. This is useful for companies with strong sales but low or no profit yet. Price to free cash flow compares the company's market value to real cash flow. The formula is market cap, free cash flow. This helps us see how expensive the stock is compared to the cash the business produces. The main idea is valuation ratios help us avoid overpaying, even for a strong company. Ratios are useful, but they must be read with context. One ratio by itself does not tell the full story. A low PE ratio may look like a bargain, but it can also mean investors believe the company is declining or facing problems. A high PE ratio may look expensive, but it can also mean investors expect strong future growth. A PEG ratio below 1 can sometimes suggest the stock is undervalued compared to its growth, but only if the company's growth is reliable. A price-to-sales ratio can be helpful for growth companies, especially when earnings are low, but it does not show whether the company is profitable. A debt-to-equity ratio must be compared within the same industry because some sectors naturally use more debt than others. The rule is, never judge a stock by one ratio only. Use several ratios together. The main idea is ratios are tools. They help us ask better questions, but we must compare them with growth, profit, debt, cash flow, and industry averages. Earnings reports are released every quarter and can quickly change the direction of a stock. When a company reports earnings, investors want to know if the company performed better or worse than expected. We look at questions like, did revenue beat or miss expectations? Did earnings beat or miss expectations? Are profit margins improving or shrinking? Is free cash flow strong? Is debt increasing or decreasing? What did management say about the future? Guidance is very important because the stock market looks forward. A company may report good numbers, but if management gives weak guidance, the stock can still fall. At the same time, a company may report weak earnings, but if investors expected even worse results, the stock can still rise. The main idea is earnings matter, but expectations matter too. The market reacts to whether results are better or worse than what investors expected. The people behind a company can give us important clues about the future of the stock. First, we look at CEO and management. A strong management team should have a good track record, clear execution, honest guidance, and good debt discipline. Good leaders can help a company grow, control risk, and make smart decisions. Next, we look at insider activity. Insiders are people inside the company, such as executives or directors. When insiders buy shares, it can be a positive sign because they may believe the stock has value. But insider selling needs context. Sometimes insiders sell for personal reasons, but repeated large selling can be a warning sign. We also look at institutions such as mutual funds, pension funds, hedge funds, and ETFs. These groups control large amounts of money, so their buying or selling can move a stock. The main idea is numbers matter, but people matter too. Strong management, insider confidence, and institutional support can all help confirm the strength of a company. This slide gives students a simple checklist to use before buying a stock. Before buying, we want to ask important questions. Is revenue growing? This tells us if the company is selling more products or services. Are earnings growing? This tells us if the company is turning sales into profit. Are profit margins strong? This shows whether the company is keeping enough profit after expenses. Is free cash flow positive? This shows whether the company is producing real cash. Is debt under control? Too much debt can create risk, especially when interest rates are high. Is the debt-to-equity ratio reasonable? This helps us understand if the company is using too much leverage. Is the valuation reasonable? Even a great company can be a bad investment if the price is too high. Is guidance strong? Management's future outlook can move the stock. Is management trustworthy? Good leadership matters. Are insiders or institutions buying? This can show confidence from people close to the company or from large investors. The best habit is compare the company against its own history and against similar companies in the same sector. This slide summarizes the main points of the fundamentals lesson. Fundamentals help explain the strength, risk, and value behind a stock. They help us understand whether the company is truly strong or whether the stock is only moving because of hype. Revenue shows whether sales are growing. Earnings show whether the company is making profit after expenses. Margins show business quality and cost control. Debt and debt to equity show financial risk and how much leverage the company is using. Cash flow shows real money generation and financial flexibility. Valuation ratios help us decide whether the stock price is reasonable, cheap, or expensive. Earnings, guidance, management, insiders, and institutions help confirm the full story behind the company. The final message is, before buying a stock, understand the business, not just the chart. Lesson explanation. This is the final message of the fundamentals lesson. Charts are very important because they show us where price is moving. They help us understand momentum, support, resistance, trend, and timing. But fundamentals help us understand why a stock may deserve that price. Before entering a trade or investment, we want to understand three things. Quality. Is this a strong business? Risk. Does the company have too much debt or financial pressure? Valuation. Is the stock price reasonable compared to the company's earnings, sales, growth, and cash flow? The closing lesson is, do not buy a stock only because the chart looks good. Use fundamentals to understand the business behind the chart.